Good afternoon, everyone. Welcome to another webinar here with Masters. We started doing this a bit back when COVID hit, and we got some really good feedback about doing these webinars. So it's something that we are planning on doing on a quarterly basis. Today, we're going to be digging into our investment philosophy a little bit deeper. We got Garry here all prepped to give you a rundown, so it should be a really good afternoon. So yeah, thanks again for joining us. Hey, we're always looking for different subject matter. So if one of you have something that you'd really like to see a webinar on, please let us know. We got the chat function that's comes along with this, and we'd encourage you to use it. If you have any questions along the way, I'm going to be monitoring the chat, so go ahead and type your questions in there, and that would be another great place for you to put some suggestions about other topics that you'd like to hear us talk about. I don't think for most of you, Garry needs much introduction, but just to humor him, I'm going to give him a little introduction anyway.
Oh boy.
Garry's been with us for 8 years now. It's been a great ride. I think one of the things that excites me so much about Garry and watching him develop is just him being a student of financial planning, and more specifically, him being a student of investing. I've really seen him like just dig into this stuff, and he loves it. He is currently the chairman of our investment review committee. He pulls all the data together for our meetings, and really knows his stuff inward, outward, backwards, forward. So, Garry, take it away. We're looking forward to what you have for us this afternoon.
Awesome. Thanks, Lyle. I appreciate it. Yeah, well, thanks again for everyone for joining us today. We've been really excited to continue our webinar series. Like Lyle said, we will be doing these on a quarterly basis, and we'll rotate some topics around. But we thought the best place to start is what a lot of you think of us doing for you, which is managing your investments, and talk a little bit through our investment philosophy specifically related to the stock market and equity investing. So equity is another name for stocks. That's what we're going to be running through today. I'm going to pause a few places throughout the presentation to see what questions we have. So please feel free to throw me anything and everything you got. I can't promise I'll answer all of them on the spot, but we'll do our best. And feel free to throw anything in there that you have. So with that, let's dive in. We're going to start with a little bit of a overview of investing history, stock market research, and how we arrived where we are today. Of course, stock market research and investing research is always evolving, and we're always keeping tabs on that and what's going on in the academic communities from an investing lens, so that we continue to stay on top of the trends that we're seeing as far as what can lead to investing success. So here's an overview of some different styles of investment management. We can really put them into 3 different categories. The first one is conventional management, or we might also call that active management. And the idea I'll put in your head about active management is a big room with a lot of computer screens, a bunch of stockbrokers with red and green numbers flashing all over their screen, making trades throughout the day where they think they see opportunity. So what an active manager tries to do is on a regular basis find mispricings in the stock market, select maybe undervalued stocks or parts of the market that are undervalued, and in a lot of cases they're really trying to time the markets. They're trying to make predictions, forward-looking predictions based on what they think. They back that into making decisions about where they trade. In general, it's a higher expense endeavor. You also have higher trading costs, and of course, the risks in general are higher there. Then there's the other side of the coin, which is index management. Many of you are familiar with Vanguard. They're kind of the father of index investing, and that's when you just buy the whole market. You weight your portfolio based on the size of stocks. So the biggest stocks, the Apples and Microsofts of the world, get the highest weighting of your portfolio, and you sit there and let it run. It's a low-cost way to invest, and it is a way to make sure you just receive the market return in general. At Masters, we believe in an alternative approach that sits between conventional active management and index management. We instead draw insights from market research, academic research, and market history, and apply that in a systematic and intentional and a repeatable process in our portfolios. So we're not sitting here and just buying the market and closing our eyes and hoping that works out. We're also not sitting here each day doing stock market research and trying to make predictions about what's going to happen next. That's a losing game as far as we've seen it throughout history. Instead, we want to draw on academic data that we can apply consistently in your portfolios. So how has research kind of advanced and updated the models that we use to analyze the portfolios and the investment opportunities within those? Back in 1963, we started with one factor. The title of today's webinar is Factor Investing. So we're going to talk about some of the factors of stocks that generally lead to higher expected returns. Back in 1963, there was one of those, and that was that stocks outperform bonds. Pretty simple and straightforward, something we all kind of know intuitively today. In 1981, after a lot of academic research, a new factor evolved, and that was that generally smaller companies outperform larger companies, and that also makes some intuitive sense. They have more room to grow, they have more opportunity when you're smaller and you're more nimble, you have more market opportunity to grow and expand, and in general, we've seen that continue to stay true over long periods of time in the market. In 1991 came the value effect. So value really looks at the relative price of a stock versus the earnings that it's producing. And another way to think about value stocks over the other side, which would be growth-oriented stocks, is value stocks are generally cheaper stocks per the earnings that they're driving to the bottom line, while growth stocks are more expensive relative to the cash flow they're producing. And then in 2012, so a relatively recent factor that, again, it takes time to academically verify that these are consistent factors. There are other factors out there that people use and invest in that aren't academically verified at this point through research, but profitability came through in 2012, and that's pretty self-explanatory. I think makes sense to a lot of us. The better the profitability of the company in general, the higher the expected return. So the more cash flow they're driving to the bottom line, which ultimately comes to us as investors, the higher the expected return of that stock. So markets evolve through time, market research evolves through time, and by keeping consistent with market research, we can keep updating our model to make sure it's efficient and employing the research in the portfolios. One really interesting tidbit in history that I wanted to include in this presentation goes back to the 60s when we had the one factor model. So the one factor was that stocks outperform bonds. And a lot of academics and investment managers were trying to figure out, well, what predicts outperformance for a stock? And out of that came what is called the capital asset pricing model, also known as CAPM. And what CAPM stated is that the higher the volatility of the stock, of the investment, the more it moves up and down, the higher the expected return. So that was the thought process. You wanted to buy the most volatile stocks. You wanted to take the wildest ride you could in the market to increase your expected return. What this chart shows is that from 1968 to 2008, it was actually the exact opposite phenomenon, and that's very, very interesting. What we saw through this period of time is the lowest volatility, or as this chart states, lowest beta. Beta is just another word for volatility in general. The stocks with the least amount of volatility were the ones that performed the best. The stocks with the most volatility were the ones that performed the worst. When that was dug into by academics, some of these other factors became the underlying results of this type of phenomenon. So really interesting piece there. And to wrap up this section on market history, in general, what we're employing and what we're subscribing to in our investment management philosophy is the efficient market hypothesis. And the general thesis behind this hypothesis that was authored by Eugene Fama is that in general, the market is efficient. In general, the stock market as a whole, so the collective knowledge of investors, is in general pretty efficient. It takes in information that's available very, very quickly, and there aren't a ton of mispricings going on all over the place in the market. What it does not state is that all investors are rational. I love that line on that slide. That's definitely true. We all fall victim to it sometimes as well. We don't all make perfectly calculated rational decisions. Certainly not all investors are, and you've probably talked with people that you know that don't make rational decisions sometimes with their investments. That prices are always right. They're not always perfectly right. They're not always perfectly stable. And it certainly doesn't state that by employing an intentional, repeatable process, that professional money managers can't outperform the market. So, Lyle, I think that's a good place to pause and see what questions we have on just some stock market history.
Yeah. Garry, I'm going to just take you back a little bit, back to these factors. Most of them are pretty sort of self-intuitive. You know, stocks outperform bonds, small over large profitability. One that's a little harder to get your hands around is this growth and value, and those terms get thrown around by investment people pretty quickly. And I know you explained a little bit. Could you maybe go into just a little bit more detail on the difference between growth and value? Maybe give us some examples of what a growth stock is versus a value stock.
Sure. Great question. So growth versus value is all about the relative price of the stock. And the relativity is what is the price of the stock per $1 of earnings that it produces. So a value stock is going to be cheaper per dollar of earnings than a growth stock is. So we might look at a value stock, and for every $1 of profit that it produces, of cash flow that it drops to the bottom line, we're paying 15 times that $1 of earnings. So we're paying 15 times on that $1 of earnings. Where we would look at a growth stock and say, oh, for every $1 of earnings a growth stock is dropping to the bottom line, we're paying 25 times earnings, or we're paying 30 times earnings based on the share price. So the bottom line with value over growth is we're paying less per dollar of earnings for a value stock than we are for a growth stock. And so that makes it pretty intuitive. If I say, I'm going to give you $1 in exchange for that, give me $15 back, and someone else says, I'm going to give you $1 in exchange for that, give me $30 back, I'm probably going to pay 15 and just buy 2 of those for the price of 1. So that's pretty simplistic, but in general, it's all about price per dollar of earnings at the company level.
So if you're looking at like PE ratios, price to earning ratios, that's going to give you, like, the higher the price to earning ratio, the more expensive the stock is another way to look at it.
Correct, because all you're doing when you're buying a share of stock is you're paying for the rights to the future cash flow of a company. It's that simple. And so and growth, cash flow and growth of the company. So that's why they call it value versus growth, because if you're paying more money per dollar of earnings for a growth stock, what you're kind of crossing your fingers for is that the growth of the value of a share in that company is going to outpace that of a company who's cheaper relative to that $1 of earnings. So we prefer to buy the more of the sure thing of cash flow rather than the hope of future growth.
Got it. Good. I think that's it for now, Garry.
Okay, great. So let's dive in a little bit more to the dimensions or the factors, and again, talk through these. And then what we're going to do really for the rest of the time is look at the historical performance of the factors, also look at the recent performance, and talk a little bit through what we see there. So once again, to recap, we're looking at stock market investing. We're looking at stocks. We're saying the first thing, pretty intuitive for all of us, there's an equity premium. In general, stocks are going to outperform bonds over a market cycle, over an investor's lifetime. There's certainly many times where that does not happen. A recent example is the year 2020 that we're in right now. Year to date, bonds have outperformed stocks by actually a fairly wide margin, as long as you're holding the right types of bonds, if I can put it that way. But in general, over time, we see stocks outperforming bonds. And again, I think we all kind of know that intuitively. Company size, again, we're looking at smaller companies relative to their revenue than larger companies, and we want to weight a little bit more toward those smaller than larger companies. Price, we've talked a lot about, that's value versus growth. And again, like you said, Lyle, profitability, pretty self-explanatory. You drop in more or less to the bottom line and ultimately to investors. One thing I think is really important to note as far as our investment philosophy goes is we are not going to exclude this huge set of companies because they don't match this narrow criteria and factors. We still believe in broad diversification in the stock market, and really all we want to do in a portfolio is tilt that portfolio toward these factors. And when we get to the end of the webinar, I'm going to walk you through how we make those tilts. So how have the factors performed historically? This is a look at how the size factor, the price or value versus growth factor, and the profitability factor have performed in three different market areas. The first column being US stocks, what most of us are most familiar with. The second area being foreign stocks in developed countries, so most of the countries in the Eurozone and things like that. And then emerging market stocks, which some are the smaller companies. And so we look at all these and say, okay, how have the factors helped us out? And I want to focus just right off the bat on this first one. And that's US stocks, small cap versus large cap. So small companies, smaller companies versus bigger companies. So from 1928 to 2019, we've seen an average outperformance of about 2% per year, small over large. So we see that and say, 2% a year. Is that really something to get excited about? We're going in all in on small over large for 2% a year. Well, let's say the average investor is invested for 40 years or something like that. Let's just say you're invested in the market from age 30 to age 70, to pick some random numbers. Probably what most of us are going to do, maybe even a little longer than that. But let's take a 40-year period. The 2% premium over a 40-year period would have more than doubled the ending value of your portfolio versus if you just held the market portfolio. And that's only 2% a year. We're looking at one of the lowest performing factors on this chart, as you can see. And you end with more than double your money. So that's just the power of compounding. And that's why in our portfolios, we want to find everything we can to just increase expected return by a little bit here, a little bit here, a little bit there, a little bit there. And all of a sudden, we're able for that to make a pretty big difference. You can see there's some different time periods here. The time periods just go back as far as we have reliable and consistent data. So we have the most of that in the United States and the most of that in size and price, and a little less of it in the foreign markets. So you see here in developed, we're only going back to 1970 for company size. We're in the United States, we're going back to 1928. but we're taking all the reliable data that we have to look at this. We look at some of these other numbers, and they even outpace what we see in just small over large in the U.S. over these long periods of time. Specifically, the price, which right now, as we'll see, has had a bit of a rough run. Growth has outperformed value actually for a few years running now. But if we give it longer periods of time, we see pretty significant outperformance. And again, that's intuitive. If I'm paying less per dollar of profit for this company and more for this one, I'm going to expect that the cheaper profit is the one that's going to outperform. But what about recently? Are there ever periods of time where the factors don't outperform the market? Absolutely, there are. And the last 10 years has been, unfortunately, a decent example of that. So in U.S. stocks, small versus large, this is over the last 10 years, 2010 through 2019, we've seen a 1.17 underperformance per year, small over large. Now, does that mean that you've lost money if you're in small and you're a billionaire if you're in large? No. Large cap stocks from 2010 to 2013 or to 2019 have returned up plus or minus about 14% a year. It's been an outstanding market run. Of course, after we had to get through 2008 and 2009, this decade has been a great market run. So we're not looking at that huge of a difference, but certainly small has underperformed large in the United States. A little bit better story over in the international markets. Price has outperformed across the board. So that's what I was referring to earlier. Growth stocks have outperformed value stocks over the last 10 years of time. Not the first time this has happened, as we'll see, because we're going to look at some more history, but certainly it's been a bit of a rough run. Profitability is a factor that's really, really done well here over the last 10 years. And this chart is a perfect example of why we don't go just all in full bore on one factor or another factor, and why we're just tilting the portfolio, because there are periods of time where the factors underperform. But as we'll see later on, in general, your probability of outperformance from a statistical standpoint is pretty darn high if you're tilting to the factors. But this is a perfect example of if we went all in on company size or all in on relative price, we might not like the results we've gotten over the last 10 years. But by diversifying and weighting to all these factors, profitability in this example has kind of carried us through to a successful investing experience. So looking at rolling 10-year periods of time, so that was just the last 10 years. Well, what about throughout history? So we're looking here at every 10-year period of time dating back to, in some cases, 1937. This first row is stocks over bonds. And these are 10-year periods of time. So some of us might be surprised to see that, wow, there were multiple 10-year periods back to 1937 when bonds actually did better than stocks. There are periods of time when that happened. Now, they weren't super significant, but this would have been 2008, 2009. That's probably the one most of us remember most vividly, when stocks had a really difficult run and bonds held water. In 2008, the U.S. market was down 37%. Stock market, U.S. bonds were up 5.5%. And that's what you're seeing right here. But over time, we see the probability of outperformance, even in 10-year period, is pretty high. And when it works, it really works. When stocks outperform bonds, they outperform them by a wide margin. When they underperform, not quite the same. We see a similar phenomenon with the other factors here. Once again, I want to focus on value over growth because of the recent run there. And this is those last 10 years, showing that growth has outperformed value in various 10-year periods of time. But one thing I want to point out to you is this scale on this chart. When we're looking at underperformance, this chart only goes down to -6%. When we're looking at outperformance, we're going up 18%. So very similar to stocks over bonds, underperformance is not generally not nearly as extreme as outperformance when we look back through history. And another trend you can all see, because we're all humans and we like to see patterns, is we have this roller coaster trend of outperformance and underperformance through time. And right now we're at kind of the bottom of the coaster. We're at the bottom of the coaster, and if we look through time, if history continues to repeat itself, we could expect to see value come back very, very strong, just like it did back in the tech bubble. We saw growth really running away. Late 90s, anything with a .com at the name was a popular stock. But coming out of that, when all of that started to collapse, a fun fact that happened in 2000 is that Amazon, which is now the largest publicly traded company in the world, Amazon from 2000 to 2002 lost 99% of its value. Now that's back when they were just selling books, but that was the kind of definition of the stock market crash. And the companies that really held up and outperformed in your portfolio were the cheaper companies and the ones that were driving profitability to the bottom line. We see a similar trend. This is for developed foreign markets. Again, you see this kind of roller coaster trend in all the factors, not as extreme here, but still see a similar phenomenon on value over growth. And then once again, in emerging markets, we're seeing the same thing. So pretty consistent across time, a little more extreme in the United States than overseas, but that's the historical 10-year periods of the factors. So Lyle, why don't I pause there and see if there's any questions I can answer.
Yeah, looking at all these 10-year periods and a lot of positive 10-year periods, it kind of takes my mind back to one of the beginning slides. You started talking about like some of this this foundational academic research was back in the 60s, 70s, and obviously it's continued, but it seems like we've got enough time going on, yet, so much of the predominant philosophy out there with investing is still that conventional management, where we're still trying to pick stocks and outguess the market. Like, why do you think this academic approach has not become like a more trendy a way of investing?
Yeah, that's a great question. So the two answers I'd give to that. Number one is you don't see any professors on CNBC. You see Jim Cramer ringing his bell and yelling and rolling his sleeves up and telling you what's going up and what's going down. It's just not as exciting, frankly. This method of investing, it's methodical, it's intentional, it's repeatable. And so it's not as exciting as trying to pick what's going to win, trying to predict what's going to happen next. Even though we all know prediction's a losing game in the stock market, it's just more fun. And if we go back to that slide on efficient market hypothesis, there's one thing that the efficient market hypothesis does not state, and that's that all investors are rational. And that's another piece of this is, again, we're employing a methodical, intentional, academically based, and long-term approach where a lot of investors, and even sometimes us as humans, we're more attracted to shorter term a shorter term lens in investing, and the pick this, pick that, predict this, predict that. For instance, just this morning, I was reading predictions for the MLB season, which starts tonight. So yes, sports are back finally. We're happy about that. But what in my mind would make me think it's going to help me to read some guy's prediction or some girl's prediction on who's going to win the World Series this year? They don't know any more than I do. They might have more data. They might have done more research. They might be able to write more eloquently about what's going to happen in the season. But at the end of the day, we have no clue. And so we just crave certainty. That's part of our makeup as humans. We crave certainty. And so we're attracted more to the what's going to happen today, tomorrow, in the future, and apply that to our investing. And unfortunately, that's proved to be a loser's game when it comes to the stock market.
Good. Hey, thanks, Gary.
Yeah. Who's going to win the World Series, Lyle, this year? I'll ask your prediction since we're into ridiculous predictions.
Of course, the Phillies will.
Of course, the Phillies. That's right. I agree.
Go Phils.
Go Phils. All right. So what happens to the factors when we look at shorter periods of time? So we've been looking at all of history, decades upon decades. We've looked at 10-year periods. What about if we scale down to now 5-year periods? So this is 5-year performance of the factors in U.S. markets. We see a very similar trend, just with more volatility. So a little more red because we're looking at shorter periods of time, more extreme areas of blue of outperformance. But again, a very similar, if I just look at small versus large, what do I see here? The same roller coaster ride of some up and some down, with our ups much higher than our downs are low. And if we look here in the market, so the stock market over bonds, we even saw that here in 2008 and 2009. So if you bailed out of your stocks in 2008 and 2009, you saved yourself a couple percent on the downside, while you missed out of 15 to 20% per year of outperformance. And again, we see similar phenomenons kind of through all of these factors in 5-year periods, where we have some good, some bad, but the good is a lot better than the bad is worse. And over time, that's what leads to the outperformance of the factors. We see again similar phenomenon here in developed foreign markets, and a similar phenomenon in emerging foreign markets. So we're going to go one more layer deep. What about 1-year periods? Lyle and I are going to start to sweat a little bit when we talk about 1-year performance, because we really don't think it's relevant. We believe in a long-term approach. But what do you have to weather? What kind of storms do you have to weather on 1-year periods? Because we're all looking at our portfolios probably a lot more than once a year, but at least once a year. And we're going to have reactions to that performance. And what this shows is, again, a little more randomness, still see lows and highs, a few more reds than blues, but once again, a bit of a roller coaster, not quite as clear on the pattern because these are such short period of time, relatively speaking. But we still see the similar patterns in most of these. And we still see, if we look at value over growth on the profitability factor, the highs, and why don't I point to some more recent ones, are a lot higher than the lows are low. Once again, pay attention to this scale. The low scale is only down -60. I say only down -60. Why don't I just say -60? And the high scale goes up to 90. So again, we have a non-equal bar chart here that we're looking at. And once again, you're seeing a similar phenomenon, just a little more volatility. You've got to weather the storms a little bit more. Again, look at this most recent period of time. We're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 individual annual calendar years. 10 of those, growth has outperformed value. So it has been a period of underperformance for value over growth. And it's actually been one of the worst periods as far as the length of underperformance that we've seen back in history. But if we look at some of these other periods, we saw some periods there, late 80s, early 90s, and we had the extreme outperformance following that immediately. And then, of course, the big one, sorry, now I'm really starting to write on this, is the tech bubble. We had significant underperformance in 98 and 99 on the value factor, but much more significant performance on the back end in 2000, 2001, 2002. on the value factor. Once again, we're going to see similar trends here on developed foreign markets, similar trends here in emerging markets. A little more randomness, a little more red, and a little less blue, but overall much more extreme blues than reds. And just to zero in on one particular factor that I point out a few times is this value minus growth. So this is a chart that's looking at the US markets from 1937 and 2019, taking all the 10-year periods of time that you could have been invested consecutively and saying, where do they rank? And as you see, we've got a lot more blue. I think it's 83% of the time or something around that we have blue. We have a few reds. These are our last two periods right here. 2 out of the 3 worst periods of underperformance, 09 to 18 and 2010 to 2019. So what happens when we have some of these really extreme moments? Well, first of all, pay attention to this scale once again. We're going up to 16 here. We're only going down to 8. We don't have an even scale. And that's because these best years up here are a lot better than our worst years are bad. And Lyle and I were on a call recently, a webinar recently, talking about the value factor. And what we see is after long periods of underperformance for the value factor, it tends to come back very, very quickly and with a lot of velocity. And if you'd study this chart more closely, you would see that a lot of these periods down here match up with being followed by periods up here. Of course, it's going to be a while till we can plot 2020 to 2029 or 2021 to 2030, but if the patterns stay consistent, that's generally what we see. So with that, Lyle, let's go back to some questions and see what's out there.
Yeah, well, one of the things that I was thinking about, as I'm thinking about these factors, the one for whatever reason seems the most intuitive to me is profitability. I mean, if you're going to be a more profitable company,
Sure.
It's generally going to, make you more money, you would think, than something less profitable. And,
Yep.
and the data that we just went through seems to prove that out. I think if I counted right, on the 10-year rolling periods, there was only three 10-year periods where less profitability outperformed more profitability. So, but it kind of it leaves me with a question then. So there's companies out there like things like Uber, Snapchat, Zillow. These companies have been around for a decade or more and haven't made any profit to date. And they've got $1 billion or more than $1 billion worth of market cap. With this data out there, why do you think people keep investing in these companies?
Yeah, that's a great question. It goes back to some of what we talked about earlier, which the efficient market hypothesis does not say all investors are rational. The companies such as you mentioned, like Uber and Zillow and Snapchat, why did you ask me about those companies in particular? You asked me about them because the two of us, and probably most of us on this call, read a headline about one of them pretty much every single day. We don't read a lot of headlines about Walmart stock or Coca-Cola stock or some of these long time, what we would call blue chip companies that would fall into some of these categories that just kind of plod along year after year after year with consistent performance and consistent cash flows. It's much more exciting for us to hear about Uber grew their revenue by 137%, last year. Obviously not over the last couple of months. It's probably down about that. Then hearing, Coca-Cola increased their dividend from 2.8% to 2.9%. Woohoo. No one's getting excited about that. So it goes back to the way we think and what we get excited about and what we don't. We get excited about what's provocative. We get excited about extreme events rather than those that aren't as much so. And then we're bombarded with that in the media. And Uber, Snapchat, all those companies, we're hearing about them all the time, where a lot of these types of companies that aren't as exciting, maybe don't have as visible of a brand as an Uber would, or a Snapchat or Zillow, stuff that we've probably all interacted with. And so therefore they're not in the front of investors' minds. And so it's easier to say, well, I keep hearing about Uber and their growth and all this stuff. Oh, and I use it all the time. Why don't I just buy Uber, even though they've never made 1 cent of profit in the history of their life? So I think what would solve that, Lyle, is if every publicly traded company put out their statements, financial statements, anonymously, and that's the only information investors had.
Right.
I don't think there'd be a lot of money flowing to some of those companies you mentioned.
Right. The one thing that I can't help but asking, and I think you've kind of addressed it, but maybe go into it a little bit more. I mean, do you ever get concerned that one of these factors, fades or completely disappears over time? Like this value thing, it's been pretty persistent now, where growth has outperformed value.
Sure.
What do the academics have to say about a difficult time like this that we're in right now?
Yes, your first question, do I get concerned? Sure. There are some times where I look at this and say, are we really sure this still makes sense? So when we have that question in our mind, how do we want to attack that question? Well, you and I could sit around a conference room and say, oh, Lyle, this doesn't feel good. It's underperformed. Let's just bail out of this. It just doesn't feel good to us. But of course, that's not what we do. We want to look at the structure of the market and say, has something fundamentally changed in the structure of the stock market that would lead us to believe that this should not be the case anymore? That would lead us to believe that paying more for a dollar of profit makes sense over paying less. And
Right.
so that's what we would come back to from a research lens. And I know you and I have both been reading a lot about this the last couple of years because we've had these questions. And what we keep coming back to is, no, that still makes sense. Again, today, why would today be any different than 10 years ago, 20 years ago, where if I offer you $1 of revenue or of profitability for $30, and someone else offers you that same dollar for 15, why is that different today, other than just market sentiment and what investors are into? The other thing that I think is important to make a point on that is it's not like value stocks over the last 10 years have been flat or had a negative return. A lot of the time when the market has an extreme upward run, as it had the last 10 years, a lot of the time in that, growth tends to outperform just a little bit. Of course, we can't predict those things. If we could, we'd be sitting on a beach somewhere in Cancun or something. But what we see is growth tends to outperform a little bit in these long bull runs, but value still has gotten you a great return from an investing standpoint. And growth about 14% a year. Give me some leeway on that, plus or minus. Value about 12% a year. So if I gave you 12% a year, I think we'd all take that over the last 10 years.
Yep.
And so I think that's an important point to make too. A lot of these times when growth is outperformed have been just great times in the market, and they've ended up running a little harder than value has. Of course, that usually leads to volatility on the other side. Risk doesn't go one way. If we have risk in a positive sense, economically speaking, that means we have to have risk in a negative sense as well.
Good.
Any other questions, Lyle, before we move to the last part of the webinar?
No, that's it for right now. Thanks.
Great. So what does this all roll back to? The first thing it rolls back to is probability. So I don't know if any of you are gamblers. I'm gonna guess probably not. I'm not a gambler. Lyle's not a gambler. I don't think any of our teammates are. either. But when you think about some other person going to, say, a casino and playing these games, their probability of winning is not positive. It's not more than 50%. The house always wins, right? So in statistical and probabilities speak, really any bet that you are offered where your probability is greater than 50%, which means over time you are likely to win, you're going to take that bet. So when they do statistical studies, if even they would say, oh, this whatever gambling game, let's just stay on that. These don't actually exist because the house always wins. But this gambling game has a 53% chance of you winning. From a probability perspective, you should play that game all the time and forever because you're going to win more than you lose over time. So how does that translate to the factors? Well, we're looking at a lot better than 50%. Even in that 1 year, so we've talked a lot about value versus growth. So even in those 1 year periods of time, value's still winning 59% of the time. And again, in statistical speak, that's a pretty big positive probability. That's a nice probability. Now, very few of us are investing for 1 year. I hope no one on this call is only investing for 1 year. Probably very few of us are investing for even less than 10 years. And the further we go out on a consistent basis, the higher our probability is for the factors. And it's even the same for stocks versus bonds. And that's what I love to compare the factors to. We all would rationally say, if bonds outperform stocks here and there, I get it, but I'm not going to go to bonds because they outperformed every once in a while. But even on a 1 year basis, you're only winning in stocks 7 out of 10 years. But that 7 out of 10 is a huge positive probability. And so we see that continue in all these other factors. The more time we have, the higher probability. And even in the short term, we're getting solid probabilities on this. We see this similar phenomenon here in developed foreign markets, and kind of an interesting one here, Lyle, you mentioned profitability. 10-year periods we're at 100%. That's not too bad of a probability. I'm sure that will come down a little bit over time because this data only goes back to 1990, but still, proves the point. And then you see a similar thing here in emerging markets. So the last question then is, how do we implement this in a portfolio? And like we said earlier, we don't believe that any one factor or any one thing going on in the market that we see is something we should go all in on, because that concentrates our risk too much. We still want to be diversified. Again, the academic studies have proved that out, that broad diversification lowers volatility in the portfolio. And as we saw back in one of the first slides, lower volatility generally leads to better returns because you have less up and down. So all we do with these factors, with our investing philosophy, is we're just tilting to the stocks that show these factors in a more positive way than don't. There are some stocks that we're going to exclude from the portfolio if we're taking the whole market, but we're just doing a tilt. And that's what you're seeing here on this chart, is an underweight to the stocks that aren't as strong in the factors and overweight to the ones that are stronger. Not if you don't get 100% check mark on all these, you're out of here, we're not investing in you. We still want to be broadly diversified. And on a step-by-step basis, this is really how it looks. This is one of my favorite charts because I think it really illustrates in a sensible way how we employ this in your portfolios. So the first thing we do is we take the market, and all these little dots that you see in this square are different stocks in the market, every stock in the market. And the way you think about this is when you fill up an ice tray. I don't know how many of us still fill up ice trays. I don't know how many of you do, but I used to. I used to put various things in them too, like Coke and orange soda, but now I stick with just water for my ice. But think about when you fill up an ice tray with water. Think about the market like an ice tray. And let's pretend every section of the tray is filled to the same height. That's where we're starting. The first thing we do is we split this in half. We split the market in half, smaller stocks here, larger stocks up here. And we just tilt that ice tray a little bit to small stocks over large stocks. The next thing we do is we split value and growth. Value over here, growth over here. So we've already tilted to small, and now we just tilt a little bit to value. And then finally, we tilt down to profitability, higher profitability here, lower up here, and we make one more tilt. And so you don't end with just one section of the ice tray filled. You just end with a tilt here, a tilt there, and one more tilt for profitability. And that's the approach we take on a consistent, recurring, and intentional basis in our portfolios. So how do we wrap this up? We started by talking about active or conventional management, index management, and then our approach. In active management, what you're doing is trying to outwit and outguess the market. It's you versus the collective knowledge and power of the market. By the way, about 90% of the trading volume in the stock market is done by institutions, many of them running very sophisticated algorithms, which is just computer trading. So do we really think that's a good way to do it? Do we think us sitting at home, or even Lyle and I sitting in our offices with the knowledge we have about investing, do we think this is a good bet? We don't. You could take the index approach. And in the index approach, you're one of these people in the crowd of the market. You're just saying, I'm just going to dive in here with everyone else. I'm going to close my eyes and just let it run and employ no systematic process or anything like that. With our approach, we're integrating and harnessing the power of stock market data into the portfolio, again, in a repeatable and sustainable way. When you're in active management, you might make up your own process, but you're picking and you're predicting. It's not a repeatable process, and so you're prone to errors, and you're prone to, frankly, being irrational. When we're indexing, again, we're just sitting there, putting our money into the market. The most of it goes to the biggest companies, the least of it goes to the smallest companies. We close our eyes and we're good to go. But with our approach, we want to harness the power of the market and of market research and implement that with a strategic lens. And we're almost at Masters obliged to end every presentation we do with this slide because it's such a good fit for our investment philosophy. We believe that you focus on what you can control. We don't focus on predictions. We don't focus on what's this one stock going to do today or tomorrow. We want to focus on what we have control over. We have control over our investments and our risk tolerance. We have control over how we structure our portfolio in line with the factors. We can structure where we invest and diversify globally, not just invest in one part of the world. We can manage expenses, turnover, and if you have non-qualified investments, non-IRA accounts, taxes, very important thing to manage. This approach is a very tax-efficient approach for those of you who have non-retirement dollars. And finally, we want to try to stay rational. And that's hard for us as humans a lot, even for Lyle and I sometimes, but we need to stay disciplined through market dips and swings. And this approach, because it is repeatable and intentional, takes out a lot of them temptation for us to get our emotions too involved in investing. If I read the rest of the appendix here, we'd be here for another 4 hours, so I'm just going to skip through there. The only reason we have all these is we have to back up all the data that we provided to you. We can send you a copy of the slides. And if you're having trouble falling asleep some night, don't count sheep, just read our disclosures. They'll be right here for you if you want them. So with that, Lyle, let's wrap up with any other questions that are out there, or anything else you think we should cover here today.
Yeah, I just have one final question, Gary. There's a lot in the news right now about how S&P is kind of getting top heavy. It's being driven by a real narrow, small group of stocks. So, a lot of the brand names we know: Google, Apple, Microsoft, Amazon, some of the ones we talked about previously. And the articles are leading you to believe that we need to be concerned about this, because if these stocks lose some of their luster, we might see a big drop in the S&P. Can you talk a little bit about how those factors play in, or maybe I shouldn't use the word factor, but how does that phenomenon play into the investment philosophy that you just described, the philosophy that we're using here at Masters?
Sure. Great question. So yeah, Lyle's exactly right on, or whoever asked that question's right on. The biggest companies, the Apples, Microsoft, Googles of the world that we all know, have really been leading the charge in the U.S. markets. They've had the best returns, especially here this year, and have kind of been pulling the whole market up with them because they're so large. So let's think about how this would apply in each different approach to investing. We'll start with conventional management, active management. If you've got the group of people sitting in front of computers with red and green going everywhere, thinking that they love Microsoft, they love Apple, they love Google as an investment, and they're predicting big things, you're most likely going to be overinvested there, and you're most likely going to feel that pain if they do indeed have a rough go of it. What about index investing? What if I just plop my money in, close my eyes, and wake up and see how much I have left when I'm ready to use it? Well, index investing weights you towards the biggest companies because it buys based on how big the company is. So the bigger the company, the higher your share. So if you're using an index approach right now, you are because of the way indexing works, you're weighted toward the Apples, Googles, Microsofts of the world. That has served you decently for the last couple of years. But if we do see a bit of a collapse in the kind of the top end of the market, or even just a flatline or kind of an averaging out, a reversion to the mean, as you might say, you're going to feel the brunt of that. Where with our approach, we don't care about the name on the stock. And I think that's a really important distinction to make. Active management and index management, they care about the name. Index cares about the size. Active cares about what they think the specific company is going to do. We don't care about the name. We just care about the data. We care about the structure of the company, the sustainability of the company's cash flow, their income statement, and their balance sheet. And we want the data to drive the decisions. We don't want just the markets. When the index approach, you're just letting the market drive your investments. In the active approach, you're letting some person, maybe you or somebody else, sit in front of a computer and their own knowledge driving the approach. We prefer to have the data drive the approach. And so we still would have Apple, Google, Microsoft, Netflix in our portfolio. Apple specifically now pays a dividend. They've been paying a dividend for a couple of years, and they continue to have strong cash flow and strong balance sheet. So as long as they still have that, we're not going to discriminate one way or other because it's Apple. We're going to discriminate based on the data, and for them right now, we'd be doing that in a positive way. But we want the data to drive the decisions, and I think that's the most repeatable way to investment success, and we believe that collectively as a whole here at Masters.
Great, Gary. Thanks for taking us through all that. It's been a great hour here, and just thank you again, all who are on the call. Thank you for the opportunity to serve you. Thank you for taking the time to be with us this afternoon. And with that, have a good evening.